Hey everyone, welcome to the Noob Selling Options channel. So let's talk about Amazon. The stock has been on an absolute rocket ship lately, right? It's all fueled by AI hype and just a constant stream of good news. But with the price this high, we're all facing a pretty big question. Is now the time to jump in, or is this just a classic FOMO trap waiting to spring? Today, we're going to dig into the source material and look at both sides of this really high-stakes debate.
All right, so here's how we're going to break it down. First, we'll look at what's really lighting a fire under this stock. Then we'll see what the pros on Wall Street are thinking. After that, we're going to pump the brakes just a little bit, talk about valuation, and here's some timeless advice from the investing legends. And finally, we'll get into a specific strategy for those who already hold the stock.
So, what's all the excitement about? It's not just one thing. It's a really powerful mix of different factors that are all coming together to supercharge confidence in Amazon right now. And it all kind of starts with one massive number. In his latest letter to shareholders, the CEO Andy Jassy dropped this absolute bombshell. Amazon Web Services, or AWS, is already on a $15 billion annual revenue run rate just from AI services alone. I mean, think about that. This isn't some promise about the future. This is cold, hard cash right now. It's real proof that they're making a ton of money from the AI boom. And what's so interesting here is how all this completely unrelated good news is just piling up at the exact same time. As you can see, everything is pointing in the right direction. They've got a great reason for their huge spending. Energy costs are coming down, which helps their margins. They're landing huge clients for their future satellite business, and they even got a better deal with the post office. It's like the perfect storm of positivity. So, with a story that good, you can probably guess how the professional analysts are feeling. Let's take a look at what Wall Street has to say. And spoiler alert, it is a sea of green. Just look at this. It's a tidal wave of upgrades. You've got JP Morgan, Citigroup, all these big firms are basically tripping over each other to raise their price targets for Amazon. And if you read their reports, there's one common theme. They are unbelievably optimistic about AWS growth and the future of Amazon's AI business. And this chart just shows you the range of that bullishness. The average target is already way up there, around $289. But then you've got some heavy hitters like BNP Paribas setting targets as high as $320. That implies more than a 45% jump from where the stock has been recently. It's pretty incredible. So everything looks perfect, right? You've got a clear growth story. All the analysts love it. It seems like a total no-brainer to just buy. But could all this optimism actually be a red flag? Is it possible that it's blinding us to some of the risks? And that brings us to a really, really important question. Just how much of this amazing future is already baked into the stock price today? To figure that out, we need to talk about valuation, and we're going to use a handy little tool called the PEG ratio. So what is it? Well, to put it simply, the PEG ratio helps us figure out if a stock's price is reasonable once you factor in how fast its earnings are expected to grow. The general rule of thumb is that a PEG ratio of 1 is considered pretty fair. Anything much higher might be a bit pricey. So, where does Amazon land on this scale? Okay, here's how the math works based on the source material. You take the company's forward price to earnings ratio, that's about 30.5, and you divide it by the consensus growth rate for its earnings, which is sitting at 16%. And what do you get? You get 1.91. Now, this is the really crucial part. At almost double that fair value mark of 1.0, this number is telling us something really important. It's saying the market isn't just optimistic, it's pricing in absolute, flawless, perfect execution from Amazon for years to come. There's basically zero room for error. A high valuation like that naturally brings us to some timeless advice from the world's greatest investors. These are the people who have warned us time and time again about the dangers of buying into hype and paying too much for a stock, no matter how good the story is. Seth Klarman's idea of a margin of safety is so important here. At current prices, with a PEG ratio near 2, there's just no buffer. Any little misstep from Amazon, maybe AWS growth slows down just a tiny bit, or one earnings report is slightly disappointing, it could cause a really harsh drop because the price already assumes everything goes perfectly. And then there's Buffett's classic line. Right now, with every analyst upgrading the stock and every news story being positive, you could definitely argue we are at a moment of peak greed. And according to Buffett, that's exactly when you should be fearful, not when you should be rushing to buy in. Howard Marks reminds us that stocks don't just go up in a straight line forever. It's not how it works.
Things are cyclical. They go up, they take a breather, they might even pull back. And if you buy at the very peak of that excitement, you're often setting yourself up for some pretty poor returns. And finally, we've got Charlie Munger reminding us that sometimes the best thing you can do is just wait. Patience and protecting your capital are so important. And this idea leads us perfectly into our final section. So, if the sources are suggesting that buying more Amazon right now is pretty risky, what can an investor who already owns the stock do? You don't want to sell it, but you're a little nervous about how high the valuation is. Well, the source material actually lays out a specific defensive strategy to handle this exact situation. The strategy is a specific type of options trade called a covered call, and you can roll it to adjust it over time. Now, since I actually own 100 shares of Amazon myself, this is something I pay close attention to. In simple terms, it's a way to generate some income from the shares you already own and set a price in the future where you'd be okay with selling them, all while protecting yourself a bit from the current hype. There are really three main goals with a trade like this. First, it just buys you time. It lets all this market excitement, hopefully, cool down a bit. Second, you can set a higher price so you don't have to sell your shares if the stock keeps running up. And third, you actually get paid to wait. You collect income, which is called a premium. To make this real, here's a practical example from the source, and it's actually what I just did with my own shares. You can roll the covered call to a later date, say September, and set the target sale price, the strike price, higher at something like $270. This gives the stock plenty of room to run without forcing you to sell, and you collect that nice premium in the meantime. I definitely don't want to lose my shares for anything less than that. And this really gets to the heart of the dilemma every Amazon investor is facing right now. On one side, you have this incredible momentum driven by real AI growth and a ton of good news. But on the other side, you've got a price tag that demands perfection, which kind of flies in the face of all that timeless investing wisdom we just talked about. So when you pull it all together, the quotes from the investing legends, that defensive covered call strategy, they all seem to point to one key virtue: patience. Which leaves us with one final and I think pretty provocative question to think about. At a time of peak excitement and euphoria, is it possible that the smartest and most profitable move is to make no move at all? I really hope this breakdown was helpful for you in thinking through this complex situation. If you got some value out of this, please consider liking this video and subscribing to the channel. It really helps the YouTube algorithm show this to more people like you. Thanks for watching.